It's been really tough for traditional media recently, and you wonder whether we're about to see the demise of businesses that were iconic and unassailable 5 years ago, or whether we're falling for the trap of retrospection and assuming that the recent past is giving us any useful information at all about what's going to happen in the future. Certainly, Channel 10 seems to be on the brink. Fairfax is under siege in the boardroom. APN News and Media has been issuing ongoing profit warnings, and Channel 9 has been effectively taken over by the lenders. Only News Corp has given the market a decent return over the last 12 months, but they continue to be in the news for all the wrong reasons. So this is the question: to buy or not to buy? It's always helpful to look at a chart, and here's a chart for John Fairfax Limited. Now, we're going to be looking at a few of these charts in future sessions, so I'll just take a moment to explain how they work. The blue line is the profit, or the earnings per share. The actual data goes back to June 2002 all the way through to June 2012, and beyond 2012 we're looking at the consensus projections of the analysts that cover the stock. The dividends paid by Fairfax are shown on the green line. Now, both the dividends and the earnings refer to the right-hand axis. The red line is the share price, and here you refer to the left-hand axis. The chart's organised in such a way that if the price to earnings ratio had been the same throughout the period, then the red line would be right on top of the blue line. And so when the red line's above the blue line, the stock looks expensive. When the red line's below the blue line, then the stock looks cheap. Based on this chart, John Fairfax looks cheap. The price to earnings ratio is around 7. That's half of what it was 5 years ago. And the anticipated dividend at current prices is around 8%, fully franked. And that'd be the same as earning 11.4% before tax anywhere else. The problem is that quite often shares are cheap for a reason. A contrarian investor might be attracted to buy Fairfax because they take the view that the company's not going out of business. And our suggestion not to buy it may be a really bad suggestion if the contrarian investor's right. But it does seem to us that technology is moving against traditional media, and there are easier ways to make money somewhere else.